Today, folks, we're going to talk about these interest rate cuts and why there's some correlations within the market, why Canadian stocks have outperformed, and speculating on future sectors that should see a one-to-one correlation of performance in the future, whether we're talking about real estate, financials, heavily debted infrastructure, utilities. I mean, it's a fascinating world we're living through because this hasn't happened in my entire investing career. We had virtually 0% interest rates throughout the entirety of my adult life, and then we went through this pandemic that caused ungodly amounts of money printing, leading into an inflationary cycle, leading to the epic rise in interest rates to now we're 5 years after that crazy black swan event, the pandemic. We are now seeing the other half of the interest rate cut cycle and what it means for this all-time high market. So if you're on a path to financial independence, if you love theorizing, speculating, and getting understandings of the market, consider hitting that subscribe button. Join me on your journey here, folks. But yeah, let's talk about it because the US just cut rates, finally kind of getting on the idea that maybe the US, even with the tariff war and a little bit of up inflation, that they can get away with cutting some rates, which is probably making Trump happy, but not by the extent that he probably wants. It was only a quarter-point cut, and same in Canada. But Canada's already cut rates quite aggressively. We're now down to 2.5%. So if you take a look, guys, they're still incredibly elevated. I mean, even the peak of 2018, we only saw a 2.5% interest rate in the US, and right now we're still sitting at a 4.25 point, whereas in Canada, even sitting at 2.5 percentage points is still materially higher than where we were at the peak of the 2010 era at 1.75%. Now, as somebody that doesn't use debt, with the exception of my mortgage, I despise debt, but some people are pretty comfortable with it. If you're running a mega cap company, yes, it would be nice to have access to liquidity, especially if you have a higher debt infrastructure company like we see with big energy and utilities that have to invest a lot into infrastructure. It'd be nice to see them get a little more liquidity. And I think a healthy interest rate is between 2 and 3%. Something tells me we'll materially go lower than this as the economy gets more and more comfortable with lower rates. And I will remind you, we survived throughout the entire 2010 era with virtually zero interest rates, and it didn't cause any crazy inflationary cycle, right? So we know that you can have more liquidity in the market without causing major inflation. We did it. But regardless, the reason I like slightly higher rates is it kind of cuts off degenerates from getting easy access to money and doing crazy things with it, but it's just low enough that people can start getting access to the real estate market again, which is why I'm saying it's likely we've started to see a bottom in real estate markets as younger people are going to get access to more liquidity as rates get lower, right? It allows them to access to more money. But regardless, why this is the most interesting time, in my opinion, is that we're sitting on $7.5 trillion of cash in treasuries. This is the US. This is an unprecedented level of cash. And when you see people like Warren Buffett, Berkshire Hathaway, with what people are defining as a war chest and what I define as just a conservative approach to investing, because most investment advisors say, hey, 20 to 30% in fixed assets, treasuries, bonds, whatever you want, just to kind of remove some of the volatility of the market. And when you can cap anywhere from 4 to 5+%, this seems like a very advantageous thing to do, especially in elevated, price to earnings multiples, which we'll talk about in a moment, that we see across the market. So my question is, and a lot of people's question is, hey, if we materially see interest rates go down enough, would it incline these kind of investors to start selling some of their treasuries off or their fixed assets and moving it into maybe more mature companies that have a longer track record and are stable with income that can kind of match similar returns? And that is the underlying realm of dividends. And we do see some direct correlations, especially when we're going to start talking about Canada, because Canada, I think, can be an indicator to what happens when you cut rates, because we're seeing it in some stock performance already. And another reason this is one of the most interesting times is people are calling this a bubble, like the dot-com era. I'm going to try and prove to you why it's not. But regardless, we're seeing record margin debt. And even in the elevated world of interest rates, it's still easier to get access to lower rated margin debt because this is typically backed by the underlying assets in your portfolio. But yeah, $1.05 trillion, guys. Whew, baby, people are getting pretty comfortable using their margin accounts right now. But regardless, and I think we can see it with speculations, right? The reason I think we're in the midst of probably the upper echelons of a bull market, at least, again, I'm just guessing, is when you start seeing, crappy investments like, crap coins, new investment theses like a lot of the covered call, like extreme versions start to come into play where there's a lot of money piling into it. I really think this is a sign. It's like, remember 2022, how scared people were and how fast NFTs and things that didn't make money went to zero. And now we're kind of in this crazy market where people are getting used to seeing massive returns across the board. And then they start buying into more speculative assets and they get comfortable doing so, is a sign to me of an extended bull market, right? But if we look at the underlying effects on the market, guys. Even with all that margin debt out there, it hasn't elevated the US markets beyond where the Canadian markets have performed thus far this year. And the only reason I can kind of conclude this to be, with the great performance of NVIDIA and all that tech, is that we have more severely sensitive interest rated companies, right? Or companies that are sensitive to interest rates. And that has to do with banks, especially considering we're primarily a financial focused country. I mean, our largest sector is finance, and then next in line is like energy and utilities, and obviously mining, which is another typically, requires a lot of funding and debt. So I'm not surprised, especially with the elevation in commodity prices, or at least precious metals, that Canada is in this new real bull renaissance that people might look at as, hey, the economy's shaky, there's some underlying concerns, sure, but you still have to look at the fact that a lot of our sectors are absolutely crushing it, and the banks have done very well with the interest rate cuts now alleviating some of the loan loss provisions they have to put aside. But one sector, and where I'm starting to see a weird disconnect for the first time, is if we look at the 5-year chart comparing the US real estate sector versus the Canadian real estate sector, Canada just did a weird disconnect. And I can only presume this is because we're starting to see the lag effects, because I got to remind you that we didn't really cut interest rates till mid last year, and then it's been a very slow endeavor to continue to cut them just to make sure it doesn't shock the economy at all. But since we've cut rates back in April of 2024, we did start to see somewhat of a rally, but that rally kind of came to an end, and we saw a similar thing going on in the US markets, and they kind of went back in line. And now recently we've saw a massive divergence. And I'm under the assumption there's a lag effect to interest rate cuts for mortgages, because, it typically takes 1 year. You don't know what the locked in mortgages look like for some of these major real estate companies. But once you get rates low enough, you can imagine there's going to start to be negotiations of mortgage rates to start increasing cash flow. And over time, we should start seeing an elevation in cash flow from infrastructure and heavily debted oriented companies. And we're already starting to see with the banks, right? Because banks have been making record revenue, but because of higher interest rates, people have to put more of their personal income to those rates, which the bank says, hey, your cash flow is depleting. That makes your loan more riskier when you're making, those payments off that cash flow, which means we have to make your mortgage a lower rated mortgage, which the government tells us we need to put some money aside just in case you default on that mortgage to protect the bank and the people that use the bank. Now we're moving to a place where, hey, now those cash flows are getting a little bit better, right? Because they're putting less toward interest rates. So the bank's like, hey, we're not as worried. We don't have to put as much loan loss provisions aside. Hey, maybe that's going to increase our earnings per share. That's going to allow more money to flow into shareholder hands. And that's why people are speculating that we're kind of in this new bull market, especially in Canada, for very specific reasons, even though price to earnings multiples are elevated, because we're going to pull forward some of the value creation that's going to go on from the interest rate cut cycle. Now, if we look at dividend stocks directly, which most dividend stocks are mature, they tend to have more debt on the balance sheets. And if we look at a correlation here and we just zoom in the year to date, we do see quite a divergence. Things like SCHD are dramatically underperforming, and something tells me that we'll be an interest rate recovery ETF. But when we look at something like VYM, I know a lot of people like that US dividend ETF. These are the US ones we're talking about. I think this one's a hard one to correlate directly to interest rate cuts because of their exposure to Broadcom. JP Morgan in the US has done far better than a lot of other companies out there, and there's Walmart. Home Depot I think could be interest rate sensitive, but I think this will still materially benefit from the cut. But I don't know if it's just the underlying holdings that have been able to crush in, because these are mega tech or mega weighted companies in the S&P, even like Broadcom. So it's no surprise that this has been able to outperform with the tech boom and many people flooding into the indexes. And there's J&J in here and some more healthcare oriented companies. But regardless, with Canada being heavily interest rate sensitive, again, with the banks, the real estate, all that stuff, if we correlate it into these ETFs like VDY, XEI, we can see that they've materially outperformed VYM and SCHD. And if we zoom out on the 5-year, just to see where those interest rates started to cut back in, again, April, May of 2024, that's where we really start to see the disconnect in performance, because these were all kind of falling relatively in line. But as of recently, with every correction in the market and every new rally, we are seeing the Canadian markets dramatically start to extend beyond US dividend stocks. So this is telling me that yes, there's probably a direct correlation, because yes, lower interest rates, lower liquidity on all these stocks is going to lead to higher cash flows, which trickles down into investor pockets. So yes, if that is the case, then we should start to see, as the US cuts more rates, there'll be a bit of a lag effect, but we will start to see the underlying SCHDs of the world, the VYMs, and these infrastructure and dividend oriented stocks start to outperform. So you could look at this if you're a 1, 3, 5 year investor, that there are better deals out there in US dividend stocks today than there are in Canadian dividend stocks. SCHD pays a much higher yield right now than most Canadian ETFs do, which is quite a shock and a surprise. So let's talk about the price to earnings multiples very briefly here. Canada's PE has slowly started to trickle down a little bit. We're down to a 19 now, which is considered overvalued. But I want to remind you, throughout history, we haven't seen times particularly like this, and I always remind you to look at the forward yields, because you don't want to be backwards looking. Because if we look backwards looking, you could say this is exactly the same as the dot-com bubble. And if we scroll down, what I also like to look at is comparably to the rest of the world. Because if you look at the rest of the world here, it is actually starting to out extend Canada. Like, the rest of the world is actually more expensive just because of the US and how far stocks have run there. But if we look at the US specifically, and we do look at the forward multiples, you'd say, hey, if you go through all the way back to 1880 here, guys, we are in a very expensive market comparably, and compared to the rest of the world, materially higher. I think a 27 PE compared to the world at a 22. This is the highest PE multiple comparably throughout a handful of times in history, but could you say this is a similar time? Yes and no. And the reason I say yes and no is because obviously you could say, yes, because you can't just trust and pull forward so much extended value without all that business and AI coming into fruition. But also no, because forward PEs and the current growth rates that we're seeing are unlike most times in history. And if you look at the forward PE here, guys, yeah, it's still pretty high. It sits at about a 23. But regardless, that is nowhere near the forward price to earnings multiples of the dot-com bubble. There is no comparable forward-looking statement that was like that. And it's not even nearly as bad as some of the forward-looking values that we had going into the pandemic. Again, at the peak of 2022, guys, which, by the way, the market's only corrected 20%. And earnings were still increasing during that correction period when we saw the inflationary cycle, the interest rate cycle, and we saw price to earnings multiples come down to 17. And that was the back of earnings going up while stock prices were coming down. So you can see that you can't correlate this into a trading mechanism at all. I think it's all fugazi, but it is fun looking at this and getting an understanding of historical periods and what it means for today, because people are screaming that this is like the dot-com bubble, but clearly if we're looking at forward values and earnings, it's just not. Is it an expensive market? Sure, but with interest rate cuts, record levels of cash on the side, we could trade like this again for some time without an economic shift. Most corrections in the market are caused by some economic shift, not just for any blind reasons. So just prepare yourself for these bull markets to go on for quite a while, guys. But looking at the markets today, scrolling around my StockTwits watch list, it was great seeing the new Meta glasses come out as Meta kind of merges VR with kind of the augmented glasses as this world starts to transform in that sense. I love my VR. I still use it pretty regularly every week. Google still crushing, hit all-time highs. S&P pouncing all-time highs, guys. I mean, we're sitting here making money hand over fist more than I make at my job right now, which is insane. And, it's wild to reach our financial goals. And I hope you're on the same path and you just keep cost averaging regardless, as I will repeat, like there's no tomorrow on this channel. Cost average into the many, focus on the few, find the niches you understand, try and crush it, excel some extra returns is what I like to say. But regardless, guys, I'd love to know what you think about interest rate cuts. If you're buying the interest rate sensitive plays, in that comment section below. And as always, I look forward to catching you in the next one.